Oh, folks, we got a good one for you today. A little bit tardy to the party. Can't lie to you, I've been pretty busy. But we're going to be talking about Netflix and their recent earnings report that happened Tuesday night. The stock was up 16.85% really today as a result of that earnings report. So you're definitely looking, to see there's probably some good stuff going on here, right? To see a reaction like that out of this stock, which has already been really taking off. Obviously, we don't want to look year to date necessarily, but we want to look over the last year where the stock's seen a 73% increase. This thing's going off pretty well, and it just recently popped off pretty hard. Let's take a look at these earnings. If you remember, I made a somewhat bold prediction for a miss on both an EPS and revenue standpoint, and I have to say there was some inaccuracy to my statement. So I was correct in terms of the EPS line. So they posted a GAAP EPS of $1.19, which missed by 20 cents from expectations. So I was correct on that aspect, thankfully. But the revenue, you know what they did? They did surprise me. Revenue of $6.64 billion, up 21% year over year, beats by $20 million. It's a small beat, it really is, but overall, it is a good beat. So good job by them. Actually beating expectations. I didn't think they would possibly be able to make it. My concern comes with future quarters and keeping people interested with less exclusives. So during this quarter, you had the charts were topped by The Office in terms of streaming for them. So the question is, what replaces that now? That's completely off the service. So that's where it becomes a question. Net ads were 8.51 million, which is actually way above guidance of 6 million. So the question becomes, where does that revenue line come into play if they were only had a 6 million guidance? It's an interesting question for sure, or why there isn't more revenue than that necessarily. So especially at increased cost per month now. Interesting stuff. So global quarter one guidance, they're expecting 209.7 million, which is a 6 million ad. Interesting. 6 million added in this next quarter. If I'm being honest with you, I don't see it happening. So again, that's part of why it popped. The EPS line, not interesting. And the revenue line, this doesn't scream to me as a reason for the stock to pop 16%, in my opinion. And not that I can see here. We'll look at more stuff, obviously. The only reason they would have popped is because of the net ads. So, and the guidance may have had something to do with it. Expecting 6 million ads, which I think they won't hit on next quarter, but we'll see. So, obviously, net ads, 21.9% growth. Pretty cool. Revenue came in line with expectations. Profits fell short. Operating income of 954 million beat consensus of 897 million. Though net income was down to 542 million after quarter three was 790 million. So overall net income fell. So that is a concern there. Quarter over quarter where you saw revenue rise, yet net income saw a decrease. Could be a concern when you're talking about profitability because you want to see this company continue to grow that line rather than shrink it. So nothing crazy here. This is just a bunch of, for the most part, quotes from the CEO. But for quarter one, it's forecasting 6 million ads as we saw, which is 14.7% growth. And obviously this is going to say they've not been averse to lowballing subscriber guidance. I don't think this is a lowball. I think for a Q1 where they don't have a lot of exciting programs coming on, I think that it's pretty well fair. For the full year, it's targeting a 20% operating margin, which would be up 2 points due to more favorable revenue outlook. It still expects long-term its operating margin will grow and average about 3 percentage points a year, which is not crazy. We do have the shareholder letter to look at to get some more details on this. So again, you see an overall decreasing line in terms of this year-over-year growth. The second line of this chart, for many reasons, a lot of it's because of the fact that you can't grow at such high rates. Whenever you get revenue getting higher and higher, it's hard to grow at those rates. You have to increase the dollar amount to keep going at those rates. So net income line even fell below what they had quarter 4 of 2019, which is a concern. There's overall a decrease there year over year. But supposedly, and I don't know how this is possible, for quarter 1 they're estimating $1.3 billion in net income, which would be quite crazy if they could pull it off. We'll see what that looks like. And revenue at 7.1 million is a 23% growth, which is back to a significant growth range. So I'm curious to see how they possibly plan on pulling that off, but we'll take a look. Subscriber growth obviously falling a little bit, better than Q3 when they only had a 2.2, but this quarter of 8.5 is pretty significant for them as well. Forecast, as we saw, for sure. So far for the forecast, they're pretty well in line, nearly a little bit above where you saw in 2017. So it's not a crazy amount of ads expected for the forecast. Lower than other years, not quite in 2020. And it's funny, in March you see where the pandemic surge hit in March, where everyone was locked in and had nothing to do. Wild stuff. So obviously they won't be able to compete with that. There's no way. So, Google, they're saying TV shows as far as what was searched most, obviously, they are Netflix originals: Lock and Key, Outer Banks, Queen's Gambit, Ozark, Emily in Paris, The Umbrella Academy, Cobra Kai, Money Heist, and Tiger King, all Netflix originals that had great good stuff. Movies, from a movie aspect, they weren't quite as significant. Not as many Netflix originals booming on there, but good for them. So overall, I would like to look at the balance sheet of this company. Take a real quick look at it. They're giving me a full year-over-year comparison, which is nice. From a total current asset standpoint, right now, they're sitting at 9.7 billion versus 6.1 billion. So a good increase there, and that's all in the cash position entirely. And total assets in general rose by, even more, 39.2 billion versus 33.9. So overall, you see an increase there of around $5 billion. Pretty nice. Some improvements in the content assets, what they own, and other current non-current assets. Pretty cool. Even property and equipment went up. Liabilities, we're not going to look to see that increase, but it's possible. Total current liabilities at 7.8 billion versus 6.8, increase around $1 billion. Not significant because, again, they rose their assets by more. Total liabilities in general of 28.2 compares to 26.3 of a year prior, so an increase of about $2 billion. But overall, they rose assets by $5 billion, so that is growth there. Stockholder equity now sitting at $11 billion versus $7.5 billion. So they've shown good growth this year, actually, in terms of this balance sheet. Not obviously the 100% premier balance sheet out there, but it's a pretty darn good balance sheet with a lot of equity on there. So there's positive numbers all over here. You just have to know what to look at. Overall, I personally still am going to stick with my original point. I don't think this thing warranted this big of a pop. Valuation's still a concern in my opinion. It's right at its 52-week high. I mean, I don't know what else to say about that. Stock right at its 52-week high, trading at a market cap of 260 billion, while bringing in an annualized revenue of right around 22 billion, I believe. It's just, the valuation's pretty stretched. We're talking 12 times the 12 times the revenue for the market cap. It's pretty stretched, and a P/E ratio around 100 is quite crazy as well. But we'll see what that looks like. Yeah, that's what I got for you today. Hope you enjoyed.